majority of the wealth that's been created in our country has come from real estate, investing, buying, owning. This is the way that so many people have been able to move forward and to build this fortune for their families, if you will.
Is what it looks like when you resolve all your issues.
But an ongoing problem that we run into is fast forward, you're 65, you're 70, you're in a position where you've amassed this equity in your home. Your home's worth all this money. And now you come to find out, how are you gonna get that money out of your home? Big problem that we run into is maybe your credit's not in line. Maybe you're in a position where you don't have the income you would otherwise need to qualify for a mortgage. Well, there are good options that are available. There's actually great options that are available that you can talk about. And in today's video, that's exactly what we're gonna do. So we have with us today, and thank you for joining us, our resident expert and one of the more valuable members of my team, Gabrielle, Gregoline. She's going to be talking about reverse mortgages, what they are, when you might want to consider taking one, and also some of the myths and the things that people may think they know about these types of loans where they're actually completely wrong. So let's jump right in. What is a reverse mortgage and why would you want one?
Okay, so a reverse mortgage is a mortgage loan that's going to allow an individual that's 62 or older to tap into the equity that exists in their home and make it liquid. So they can put that equity to work, right? And it might be that they want to age in place and they need to make their home, work for them.
Okay.
Or maybe they need home improvements that they want to be able to do. Maybe they just want to take that dream vacation. Whatever it is, basically, when we're living in the home, the reverse mortgage gives an opportunity to get at the equity and make it liquid.
Okay, so now that we know what a reverse mortgage is, what are some of the common myths or the misunderstandings people may have about this type of loan?
Okay, so they abound. The one that I hear the most is that the bank owns the home. So they think somehow they have relinquished, ownership. And
Okay.
that is not the case. A reverse mortgage, it's a lien on the home, just like a traditional mortgage. So the borrower is still on the title.
So they still own their home. They're not giving up ownership rights, and they're not going to be in a position where the bank's going to later come on and take that home from them.
Correct. Nope. They still own it. It's just a lien.
Are there any other common misconceptions, things that people talk about where you're like, no, that's not how this works?
Yeah, a lot of people think that if they do a reverse mortgage, just like put a big X over the house and I'm trading it in for cash and there's not going to be anything left to leave to my heirs. And honestly, that's very seldom the case. And this is something that we are able to illustrate when we look at a proposal because of the set aside that we account for of interest that's going to accrue on the loan over time. And it's designed so they retain an equity position. There is almost always a significant amount of equity remaining in the home. Plus, it's typically going to be an appreciating asset, right, in most markets. So yeah, there is often a lot of equity remaining, and people are really surprised to see that.
So this is an opportunity for someone who is 62 and older, so most likely they're at that age where they're retired or reaching retirement. And now they have this home, maybe they own it free and clear, right?
Mm-hmm.
I mean, so many Americans have built up the majority of their wealth in their home.
You're absolutely correct.
Right? So now fast forward, I'm 65, I'm retired, life's looking pretty good. Matter of fact, my home's worth a lot of money. But then I run into the problem when I try to take out a traditional mortgage and find out, wait a minute, I don't have any income. I can't actually get a loan. I'm going to this lender. This guy's telling me I can't even borrow money. What's wrong with him?
Right.
Would a reverse mortgage would be good in this situation?
Yes, you hit a major point. So when people are retired and they're on a fixed income, it's a lot harder for them to just walk into the bank and qualify for a traditional loan. And the way the reverse mortgage is structured, the credit doesn't come into play, and the debt to income ratio doesn't come into play in the way it would in a traditional mortgage because there is no payment required on the reverse mortgage loan, just property taxes and homeowners insurance.
Got it. So debt to income is going to be when we look at how much money you have coming in versus how much money is going out, basically, right? And lending, we like to use a percentage of that. Traditionally, we want to make sure no more than 45% of someone's total monthly income is going towards their total monthly debts, which when you're in a position where you've got this home owned free and clear, I mean, sometimes with retirement, taxes and insurance on that property, just the cost of ownership for that property could eat up more than half of their fixed income. Have you seen that?
Yeah, definitely. And I run into in a traditional financial institution, loan officers that they're like, I cannot qualify somebody because of the fact that they just don't show enough income for what a potential payment would be for, like, let's say on a HELOC, which is a really common way to access home equity. But you have to be able to support the potential payment that comes with if you actually use that money,
Right. Makes sense. When would someone not want a reverse mortgage?
So that's a good question. If somebody can't, like you said, afford to maintain the property taxes and the homeowner's insurance on the home long term, if it's going to become a financial issue for them, then that wouldn't be a good opportunity for a reverse mortgage. If they have demonstrated some irresponsibility in their spending, they might not be the best candidate. But the primary thing is going to be if they are going to remain in their home or not. So if somebody, kind of like with a refi, right? You wouldn't advise somebody to refinance for a lower interest rate if they told you they were moving in a year or two.
Right.
Doesn't make financial sense. Same with the reverse mortgage. If they don't plan on staying in the home long term, then it might not be the best fit for them.
So there's a timing aspect to this as well. It's not only, I heard you say earlier, 62 and older. So you have to be 62 or older.
Yes, at least one borrower.
Okay.
Yes.
And then outside of that, there's a timing factor on whether or not this is a good fit. And this is going to be based on how long you plan on staying in your home.
Correct.
Okay. Got it. Now, let's say that I'm 65, which I'm not. And we're in a position where my home is owned almost free and clear. I have a small mortgage on it. Maybe it's worth, say, $800,000. And now I have about $150,000 left on my mortgage. But I locked that in at a really low interest rate. I have 2% money on my home. I really don't want to lose that loan. I want to keep that in place because, let's face it, that's about as cheap as that money is going to get.
Right.
So is there a position there that a reverse mortgage might actually fit?
So depending on where you're located, like in Illinois, we do have some proprietary products out there is the answer to that question that can come in behind the first lien. So that low mortgage interest could stay in place.
So you'd actually keep the first loan and now you're going to take out a second loan that's a reverse mortgage?
That's a reverse mortgage that doesn't come with a required payment. So that's the big thing we want to remember, right, with the reverse mortgage is that the payment's optional. So you can make one if you want to, but you never are obligated to. So yeah, that would be a proprietary product where the low interest rate, because we do run into that, right? Because we had that market a few years back and people they're so happy about it and they don't want to sacrifice that interest rate. No,
I think they call this the great lockout. It's the great freeze right now. No one wants to move because their money is so cheap.
Exactly.
Yeah,
it's like, I scored a 2.5%. I'm not going to give it up.
I do have 2% on my home. I'm not going to lie.
Okay, well, I liked you before this. It just went down a little bit.
So going through and looking at that then. So we have requirements 62 and over. You do have to have a certain amount of equity in your home as well. I know we're talking about the goal here is to be able to access that equity in your home. So if someone has, 30%, 40%, 50%, is there a general rule of thumb as far as how much equity someone has to have in their home to qualify for this type of loan?
There is. So there's a equation that happens in the background, and there's a few key factors that could play into that. It's going to be the age of the borrower, the current interest rate, and then the value of the home. Okay. So the older someone is, the more equity they can access. And that's because reverse mortgage loans don't have a term on them. So they're actually going to stay in place as long as the borrower, at least one borrower, remains in the home. And then the loan will stay in place and there's no payment, right? So there's no 15-year or 30-year term. So if somebody is younger, theoretically, they're going to have the loan in place for a longer amount of time. Okay. Because there's no payment due, we set aside a portion of that equity that they're accessing for the interest that's going to accrue over time.
For sure. Right. The cost of ownership is going to still...
Exactly.
It's ongoing. This isn't
right.
free.
It's not free.
Okay.
It's not free. So the interest rate and the age is going to come into play. So an older borrower with a lower interest rate environment is going to access more money. And so if somebody was 62 a few years ago, they were getting at close to 50% if they implemented a reverse mortgage. They would need to have like 50% equity in the home, where now that's more like around 35 because the interest rate's a little higher. And it's structured so that they retain an equity position in the end. There's still equity in the home.
Got it.
At the end of the loan.
Do you have a basic calculation on how to break down for people who are watching how much equity they have? You know, I think that we hear this term all the time, equity in your home's value. What's an easy way for people to understand how much equity they possibly have in their home?
So we do a certified appraisal when we base it on an estimation, right? We'll go to Zillow or whatever. What do we think the home is worth in the initial proposal stage? But ultimately, it's a certified appraiser that comes out. So whatever the difference is between what the appraiser says the value of the home is and what you owe on a current mortgage, if anything, that's going to be the equity.
All right. So based off calculating someone's equity, now I have, again, we'll use simple math. I have $1 million home. I owe $100,000 on this property.
Mm-hmm.
That means if I subtract that from 1 million, Zillow tells me my home's worth $1 million, and I subtract that $100,000, I now have $900,000 in equity.
Right.
Now, immediately I think, well, okay, so I can take $900,000 out of my home. I'm guessing that's not the case, and that's not the way this works, correct?
It's not exactly the way it works. And I'm glad that you brought this up because it's important to note the differences between a HELOC and a reverse, because a HELOC is going to allow you to access a larger portion of the home's equity. And because a reverse mortgage we set aside because there's no payment due, that percentage is smaller. So you're going to be able to get at, based, like I said, on the age and interest rate, a percentage of that. But we have to be in the first lien position. So whatever that total amount is, we've got to pay off that $100,000, and then the rest is yours to access.
Makes sense. So if I could take out, let's say 50%, I can take 50% out of my equity. So half of this. I have $1 million home. I have a $100,000 loan amount on this. Now, technically, I can qualify to take out 50%. That doesn't mean I can take 50% of the $900,000 that's left over. It means that I basically can access $500,000, but of that, we have to subtract the first mortgage out of that.
Yeah, you got it.
Okay, got it. All right. So like I said, I like to use simple math.
Yes.
Follow through with this. Much easier for me.
Yeah.
So.
And let's talk for a second about what we just did in that situation. So you've both eliminated whatever existing payment was on that $100,000 mortgage loan.
Okay.
No longer has to be made, and opened up another $400,000 that you can access when needed and not create an additional payment. So that can be so powerful for people.
I think that's an amazing example, because I have clients who were in a position they don't want any debt going through, right? So I helped them. We did refinance. We used a 15-year mortgage. They wanted to go through and they wanted to lower the amount of interest they're going to pay on the loan. They also wanted to pay it off fast. Well, fast forward, things didn't move as fast as they would have liked. And they're in a position now where they still have this loan and the 15-year payment was too high for them. They're coming to me asking how they can take equity out of their home to pay off the loan. And I was looking at this, a little bit stumped, thinking like, well, that's not how this works. You want to take a loan out to pay off another loan so you have no payments, and that's not the way it works. However, with a reverse mortgage, it is actually how it would work. Is that correct?
Right, it is. And that's a dangerous game to play, what they were talking about. And I ran into a situation similar where people will do that. They'll go, well, I'll just go get a HELOC, and I'm literally going to make the payment with the HELOC that has a required payment already, that's going to recast in 10 or 20 years, that's subject to potentially being called. I mean, there's a lot of risk in there when you know, to use that option. But hey, it's super common, and so many people don't know what's available with the reverse mortgage loan.
Yeah. So let's talk for a minute. HELOC, right? We've heard this term now several times. HELOC is it's the acronym, right, for Home Equity Line of Credit.
Right.
And there's also a HE loan. So a HE loan is going to be much like a HELOC. These are mortgages that allow you to access the equity in your home, but they don't interfere with your first mortgage. A home equity line of credit traditionally is going to be an adjustable rate, moves up and down with the market, whereas a home equity loan, it tends to be a fixed product. Now, not to get too deep into the weeds with this, but I think it's important to understand, because we're talking about accessing the equity in your home. And I think that a lot of times, as you said, my go-to move is a home equity line of credit, because it allows flexibility. So the HELOC allows someone to take the money out of their home. And what a lot of people will do is they'll use this as a safety net. So say, okay, I'm not going to actually borrow the money. I have this home equity line of credit. I'm not going to borrow the money because now I don't have to pay anything on it until I borrow the money. And with the home equity line of credit, you only pay interest on the amount borrowed. So this can be a good method for people who qualify for these traditional loans. The home equity loan is great because it's a fixed rate. I think that when you're going into later on in your life and you're looking for stability, it's tough to take on the risk of something that could adjust up or down, like the home equity line of credit. So we'll have clients who want to look at that HE loan. They want to look at something that's going to be a fixed product. The downside to that is they borrow the money up front, and now they have to continue to pay on that principal and interest out of the gate. You get that fixed interest rate, but you also get that fixed payment. What I love about the reverse mortgage in this scenario is it allows someone to access the equity in their home without taking on that monthly payment. Because if you're going into retirement, especially I think if someone's waited a long time to take that trip, right? They've gotten there, they've put in all the work, and they're going to go somewhere. Well, now they're in a position where, I don't know, they went to Disney World, okay? That's where they want to go. It's fresh on my mind because we're about to go to Disney World. We're taking the kids there for the first time. Help us. And I was thinking about this because it's expensive. Really,
Right.
I joke around. I tell my friends, they're like, "You're going to Disney World." I'm like, "Yeah, I'm applying for a second mortgage on my home to pay for it." Well, when someone's retiring and they're going to start to take these trips, I mean, they're dipping into their retirement funds, their expenses. Let's say they have fixed income. Now they're in a position where they want to take that trip to Italy, and yes, they budgeted the amount that they need to go and where they're going to stay. But the problem is that those bills keep going while you're gone.
Right.
The biggest one could be their mortgage and their home.
Right.
So it seems like the reverse mortgage is a great opportunity to be able to pause that and to be in a position where now you can eliminate the monthly payments and the expenses, get that equity out of your home, which is otherwise locked up. And that's a big problem we run into is if someone's in a position where they can't qualify for a traditional loan, now they can't get all that equity without selling their home. And people don't want to sell their home, right?
And you touched on that in the very beginning where you said, like, for most people, their home is their largest asset, right? The average person doesn't have $1 million, $2 million in their retirement savings account. They have their home. And that's where their net worth is in that equity. Traditionally, to access that, you would do a cash out refi.
Right.
A HELOC or the HE loan, or you would sell it.
Right. Those
are the only ways you're getting at that equity. And what happens? You've created a payment if you do a cash out refi. In a lot of situations, a larger one, right?
Right, for sure.
And then you've created a mandatory payment with the HELOC. And then you've had to sell the home to get at. So the reverse mortgage is just another option on the table when somebody is looking at what is going to be the best fit for me. And unfortunately, because like I said, there is a lot of myths and misconceptions, just unawareness about how the product works, it doesn't get talked about.
Right.
It doesn't get presented by even the loan officer to the consumer. So that's why this is so important because, yes, the fact that they can access that money and not worry about what payment is attached to this. Because I don't know about you, Sam. I feel like we're close in age. You're younger, I think. But you get to that point where with your parents or your aunts and uncles, your friends' parents, whatever, and they're retired. And when they're talking about, I know my dad was looking at buying a car, and they will just go over and over and over the decision. They're scared to really spend their money because they are in, and it's not that they don't have enough in every situation. He lives in a beautiful paid off home. I don't know how much money he has. That's a weird question for me to ask, but I saw him struggle over the car. They're afraid to tap into it. And this gives them a little bit of freedom that, hey, it is your home. It is your equity that you worked all those years paying for. You deserve it now. Don't you want to get at it and spend it, but not feel obligated? So that's a decision that they have to make for themselves, but it's our job to make everybody aware of how the program actually works.
I love that. So let's say we're in a position where this is a good fit. I've decided I've taken out a reverse mortgage on my home, and now a year later, well, maybe I don't need the money anymore. Or I'm worried like your father, I'm worried about how this debt could be building up and what's going on. Do I have any control over that?
So yes, you absolutely do. You can refinance out of the reverse mortgage. You can pay it off. You can pay it down. So let's say somebody, they do a reverse mortgage, and like you said, a couple years later, or whatever, they're thinking, I don't want to have this in place anymore. They could just pay it off, or they can refi it into a traditional loan if they wanted to. I mean, you're not locked into it, but you are guaranteed access to the money when you put it in place, which, like I touched on with the HELOC, that is such a common use to get at the equity. But we have to remember that those can be frozen and called, can and have been during the housing market crash. I
saw that.
During COVID.
Right.
So once a reverse mortgage is placed, as long as the borrower continues to pay the property taxes and homeowners insurance, and it is their primary residence, they're going to have access to that.
I think that's great. Well, and I think that as we talk through this, it only reinforces why I have someone on my team, Gabrielle, who works with my clients to help them understand if this is the right decision. Because there are a lot of moving parts. You mentioned before, when someone asks you for a loan, when someone would come to me and they would even talk about reverse mortgage, I generally would just be like, yeah, no, because I don't want to give them the wrong information. I don't want to be responsible for putting someone in a position where I didn't even realize that they could stop paying on the reverse or stop taking the draw out or paying it down. And that's why we have someone who focuses on this and who's a professional who understands when this could be a good fit. So we've talked about what is a reverse mortgage, when maybe it's not a good idea for a reverse mortgage, how someone can qualify, and reaching out always to a qualified mortgage professional and having a better understanding of if this is a good fit or not. Are there other levels of protection? Because I feel like this is a pretty regulated, highly regulated space.
Yes. And I'm so glad you bring that up, because the fact is that reverse mortgages kind of have a bad reputation, right? People either don't know, they don't even know. It's like one of those things where, like, you don't really know why you think that way, but somebody told you along the way that they weren't good,
right.
And I think it's important that we address that. So because we're dealing with the senior population, they are heavily regulated, and it's a protected class. So when reverse mortgages first came out, which is going to be back like during Reagan, I believe, it didn't have the same rules and regulations that exist today. So now if someone wants to do the reverse mortgage, after they talk with someone like you. Yeah, you refer them over to
after
me.
They talk to you.
After they talk to me. Then they are going to go, if they decide they want to move forward, they are going to go through a counseling class through a third party that is going to explain everything that I did. And my job is to make sure they're not learning anything new on that call, that I've covered it all. And that they're going to make sure that they understand it. And it not only protects them, but it protects myself or an advisor if they're involved, that the consumer understands the product. And there's a certificate that they sign at the end of it. Also, this person is making sure that they're competent. They seem a sound mind. They're all there. So that's a biggie. And it's just a 45-minute to an hour long call, but it's important so that they understand. So that's one of the things. The other thing is it's going to be that it is an FHA insured loan, the one we're talking about today. They're I mentioned.
So it's a government insured loan.
Yes.
All right.
So there are some proprietary products out there that are good that are not FHA insured, but the main one that's being utilized is. So that insurance is in place to make sure that if the loan were to go upside down, at some point the balance of the loan exceeded the value of the home, it's going to come in there and pay the difference. So you can't pass any debt to the heirs. So it's a non-recourse loan. The home is the collateral for the loan. So
I think one of the biggest concerns that I would have if I was taking out this reverse mortgage would be, as you just said, what happens if all of a sudden I owe more than my home's worth? How do we protect, the borrower against this? What's in place to make sure that they don't end up in a position where they were worse off than where they started?
So the way they would protect against that is, first off, the way the loan's structured.
Okay.
I had mentioned we loan less than a traditional HELOC. So it's designed so they have a retained equity position at the end.
So there's like a safeguard as far as making sure that they don't absorb all the equity in the home.
Right.
Okay.
Now, it's not to say that it can't happen, because if somebody were to access all that money right away, or let's say we often will do a reverse mortgage and all the equity that we're accessing is used to pay off the existing first.
Okay.
So maybe they can only get at $300,000 and they've got a $295 existing mortgage. So they're starting with a higher loan balance, right?
Right.
Now we've just eliminated a mortgage payment, which is huge.
Okay, got it. So maybe they're not taking it's a position where they're not exactly taking out money every month, but they're getting rid of the fact that they have that payment.
Yes.
Okay.
Yeah.
That is big. I think that's very big.
Yeah. So we see that a lot, and especially because so many people refied in the last few years. So your particular borrowers that you mentioned earlier, where they refied and they cut it down to a 15-year, right? But not everybody did that, right? So they re-engage a 30-year term. And if you're over 62, I mean, we might be eliminating a $1,500, $2,500 payment that someone was going to make for another 26 years,
right?
You know, and now they're allowed to keep that money in house. And we've created that extra cash flow. So again, optional.
I like that. I think that's great.
Because they can make the payment if they want to.
So in a market that goes up and down, like they often do, right? We see so many different variations across the country. And depending on where you're tuning in, you'll find that markets are crashing, markets are soaring, and they're both right. It just depends on where you're looking at. If someone takes out a reverse mortgage and something happens, let's just say that when they took the loan out, their estimated home value was much higher. And during the process, that value drops. Now, what happens? Are they on the hook for a payment? Are they in a position where they're still going to be able to avoid that monthly payment? What happens if, unfortunately, the market goes down?
So the really cool thing about a reverse mortgage is once you put it in place, you don't have to worry about the value of the home as much, because you're going to be able to stay there with no payment due for as long as the loan is in place, and that insurance is going to cover the difference. Even the proprietary products are non-recourse. Okay. So the home is the collateral.
So by non-recourse, it means your value dropped, but we can't take your home.
Right.
Right. And it's not a traditional loan where it's saying, well, you're not paying us, so we're going to take your home. In this case, maybe we're not paying you, the reverse mortgage, if they were taking money out. Right. Let's say now there's no equity to take out, but now the non-recourse means you can't come back and they wouldn't lose their home. They'd be able to stay put? They
would be able to stay, yeah. Okay. And let's talk about that for a second, because one of the biggest differences between the reverse mortgage and a HELOC, I'm going to touch on a couple real quick.
Please.
Okay. So if people are considering those two options, a HELOC is going to have a required payment, right? The reverse mortgage does not.
Got it.
A HELOC is going to have a term that,
for sure,
right, and that you're going to have to requalify for at the end if it's still in place.
Very true.
Right. The reverse mortgage does not. You're just going to qualify the once. A HELOC's going to be based on debt to income, and can you handle what that payment could potentially be?
Right.
Right. Where the reverse mortgage is not.
Okay.
Okay. And a HELOC can be frozen and called, where the reverse mortgage cannot. Right. So those are some of the main differences. Now, the biggest is going to be that a reverse mortgage line of credit has a growth factor attached to it, which means that it grows and compounds at the same interest rate that's attached to the loan balance. So we'll use math, right? Because that's you
simple
like to
math,
do it, and it's simple math. Okay.
Yes.
So let's say you were to borrow $100,000 through a HELOC. Okay. That $100,000 is $100,000 day one. Year 1, year 5, it's 100,000, right? Whatever you use, but it's not over 100 unless you redo the loan.
Okay.
With the reverse mortgage, you're accessing $100,000 in the line of credit. It is going to grow and compound at the same interest rate. So if we're at 6%, that 100,000, if you're not using it, becomes 106 at the end of the year.
Okay, so you're actually building on how much you can access or how much protection you have.
Yes, and this is a tremendous feature of the product, because it would be a reason why someone would want to implement the reverse loan earlier at like 62 or 65 versus later. Because think about the potential that $100,000 or $300,000 has to grow over 10, 15, 20 years.
Right.
And it's not tied to the value of the home at all. So the value of the home could literally plummet. We could experience another housing crash, and it would not affect the line of credit at all. It's the interest rate that's attached to the loan.
Got it. So that money's growing, which potentially then, if I understand you correctly, offsets the risk of the value of the home regardless for the lender. Let's face it, we're in the lending business. Primarily, we like to lend money and get it back. That's
Right.
what we do.
Right.
So as a lender, the reason, and I think this is important because as you mentioned earlier, sometimes people feel like there's a bad rap. They're saying like, hey, wait, what's in it for you? I mean, when you lend money out, people want to know what's in it for you. Well, interest is. So obviously we're in this case where we have to be protected as well. Otherwise, certain amount of defaults, these loans are gone, right? Now,
Right.
So that protection for a lender is that they are government insured. So that, and I know from other FHA loans that allows some flexibility, which is great. And then on the flip side, they're offsetting for a lender that risk because it's based off the growth of that equity and an actual compound interest factor. So that money's growing against the value of the home instead of focusing on this line of credit that's only based off accessing the equity, which is based off the home's value going up and down. Is that correct?
So it's right. The line of credit isn't based off the home's value going up and down.
Right.
Right. Because it's separate. That's what you were saying.
Yes.
Right. Yeah. Yeah.
Exactly.
So because people think, oh, it's I'm going to have less because, depending on what happens with the value, and it's not, it's separate. And there are multiple ways for them to access that money too. So should we talk about that for a second? How do they, once that money's available through the reverse mortgage loan, how they can actually get at it?
I think that's great. So how do they get at that money?
I'm going to tell you.
Please.
So there's several options, and one is that they can set it up as like a monthly payment. So maybe they say, I want $1,500 a month to come automatically be deposited into my account from the line of credit, right? Or they could just let it sit and say, when I want it, I will transfer. It gets transferred to their account. I'll request money whenever I need to access it.
So on demand.
On demand.
Got it.
Yeah,
Okay.
I like that. Or they could set it up with what's called a tenure option. And I'm going to spell this one, TENURE. So similar to an annuity,
That
right?
doesn't
Not
sound like the proper spelling.
Not tenure. Tenure, which means as long as the loan is in place, we could structure it where they receive a guaranteed payment for life.
Okay.
Right? No term, for life. As long as they're living in the home, at least one borrower's in the home, the loan's in place, they can count on that payment. So basically we take that $100,000 or whatever it is and say, based on your current age and expectant life expectancy tables, we will commit to X amount of dollars monthly, which is huge, right? Somebody's looking for supplemental income that they can count on, and then they know that I don't have to worry about, spending down that line of credit or running out.
Okay.
I can count on this, to be there.
I think that's amazing too, because when you're looking at this, a lot of people have retirement plans put in place. Not everyone, right? I mean, you mentioned earlier about how much people have in savings. I mean, the sad fact is that the average American, not qualified for reverse mortgages at this time, but in younger generations, has on, I believe it's somewhere around $3,600 in savings. Whereas you see a lot of numbers out there that give you a much broader picture saying, oh, Americans have $50,000 in savings. It's the way it's skewed by the averages. The reality is that the majority of the population does not. They are living check to check. So as you look towards savings, that's a problem. Now, in these cases, we're looking at, I don't want to say baby boomers right now because I know that they're in the media a lot, but the reality is baby boomers, and boomers are taking advantage of these types of loans, and with good reason. So going through that, if I was in a position where I've saved, I have retirement, but again, I'm in a place where now I'm on fixed income, I probably have an advisor who's has my money working for me. And I think that what happens is that when someone reaches that retirement age, then more often than not, they can find themselves in a position where now they have to interrupt that investment strategy because they need the equity out of their home. So it seems like this would be a really good product for advisors to work with their clients when they want to make sure that they can look out for their clients, protect them, and help keep their money growing while still making sure they have enough money to take that trip, or making sure that they're not in a position where they're uncomfortable and they can't buy that new car.
Yeah, absolutely. Oh, I have a lot of conversations with advisors about this because, again, the education reverse mortgage, it doesn't discriminate, right? It's whether it's loan officer, advisor, consumer. There's just a lot of lack of understanding about how the product actually works. So if somebody, think of it like this, the equity in the home accessed through a reverse mortgage is going to be a alternative bucket of money
Okay.
tax-free because it's borrowed money, right?
Oh, great. Right. You've already paid taxes on it.
Yeah. So somebody needs, if they, my dad, he wants to buy that new car and it's $30,000. It's a true 30 that he's going to draw from it, right? Because he doesn't have to account for taxes or anything. And it allows them to have some control over sequence of returns. So you think about, like you said, the market, depending on what's going on, it's up or down or whatever. And we can't control when people are in their retirement stage, right? And now they're drawing from that portfolio. Well, they're taking their monthly distribution or whatever, whatever they're taking to live, they've accounted for. If they had the opportunity to hit the pause button on that and draw from this bucket instead,
right,
when the market's down, so that they're, right, you don't lose money on a stock that's down until you what?
Sell it.
Until you sell it, right? So they can be in a hold position and pause on their money just several times over a 10, 15-year period. There are studies out there that and books that have been written that talk about this. It has a tremendous impact, whether that money's a reverse mortgage or under your cousin's mattress. If you cannot draw from your portfolio when it's down, it will have a huge impact on the amount that you have left over in the end.
That's great. That's actually a very important point. So if I'm following you and what you're saying, if I'm in a position where now I need money, and let's say I don't have, or I do, I have this reverse mortgage in place, and now I need money and I need cash from my retirement, normally where I would go for that, but the market's down. It's all over the place. Now, all of a sudden, I'm going to not only interrupt that investment strategy, but I'm going to be taking a loss on some of this because I have to liquidate. I have to sell, right? Sell these stocks. So that's a problem. Now, instead of doing that, I can go through and keep my money working for me. And now I can dip into this reverse mortgage to get the funds out that I need for that, for whatever that event is, or for how long I need that money without getting in the way and losing that money.
Yes. So that would be one super important strategy. Another one would be, because, like I said, and most financial tools, time is your friend, right? You want a long span of time for them to work for you. So as far as when it comes to investments and trying to make money on something, right? So if you implement the reverse early and have that line of credit growing over time, it could be used for multiple things. Maybe somebody wants to delay taking their Social Security by a few years so that they get a larger check, right? The reverse mortgage, you could use those funds to supplement. Maybe, and this is not a huge percentage of people, they actually have a long-term care policy in place.
Okay.
A lot of people don't because they're expensive. But because they're expensive, sometimes people have them and then they let them go later in life when they're finally at the point where they're most likely to need them, because they're like, I don't really pay that bill anymore.
For sure.
So the reverse mortgage could help supplement that. If you put it in place early and that line of credit grows, you could potentially self-fund long-term care. So I'm going to do this at 62 so that I have $500, $600, whatever it is, $1,000 later that I can use to pay for in-home care if I need to, or whatever medical bills arise. So that's what's neat. There's so many different applications for it. What you do with the money once you access it, it's your money. We're out of that. I
love it. So a reverse mortgage is a great way for you to tap into the equity in your home while maintaining a protected stance. You're in a place where you're protecting your home. You don't have to make a move. You're in a position where you're protecting your investments and you don't have to draw on those investments and otherwise get in the way of, the growth of your money. And you also have opportunities where you're looking down and protecting yourself, looking down the road. Like you said, you're 62, you're in a position where now you're protecting yourself and making sure that you have that opportunity to maybe save enough money or grow your money to where once you do hit 70, or if you're in a position where that cost of living is going to extend and you have to pay for long-term life care, then you're going to have put something in place that can work for you.
Yes. And I think that if in the conversation, both as loan officers or as an advisor, anybody, when you focus on what the loan does, right? Creates access to the equity in your home, without a payment that you can count on. You change the way you look at things, it will change the way it feels. So peel back the layers on and don't let some emotional hangover about reverse mortgages get in the way of what you thought you knew or somebody said.
Right.
And what does it actually do and how does it work? And what are your goals? As an individual, because I'm sure advisors could relate to this a lot. I know in my conversations with them, it is often just kind of like a checkbox, like I want to pay off the home,
right?
Right?
For sure.
I want to be like your clients,
I want to be debt free.
I want to be debt free. And there's nothing wrong with that. But depending on what the actual situation is and what your goals are beyond the check mark, like, okay, because being debt free is going to allow you to do what? And where's that money going to come from? So meaning I had an advisor, like he has clients come in and they're like, okay, I need to take out $120,000 because I want to extinguish this mortgage. I'm retiring next year. Okay, but what if there was another way to make that payment go away? And you could leave that $120,000 to make more money to help you live your retirement the way you want to. So
I love that.
We just want to create options for people, right? Knowledge is power, and then they can decide what's the best fit.
So we're talking about someone's in a position where maybe they don't want to leave their home. But the reality is the older you get, that home that was ideal may not be perfect anymore. Maybe you're in multiple level living and you got to get rid of the stairs, something of this nature. So let's say we're in a position where we're looking at needing to buy a new home. We have all this equity in our current home. We need to buy a new home. How does a reverse mortgage come into play in this situation?
So there is a reverse for purchase loan.
Okay.
So somebody can use a reverse mortgage to purchase a home that's new to them. And like you stated, they could be in a home that doesn't suit them, but what they can sell it for doesn't allow them to purchase a home. They're not able to find a home that suits their needs. Maybe they're moving because they want to be closer to grandchildren, or maybe, like you said, it's a 2-story and they need a ranch. The reverse for purchase loan helps increase a buyer's purchasing power. And
really?
Yeah.
How would you explain that? Let's dive into that.
Okay. So let's say an individual has a home worth $400,000 that they're going to sell, right?
Okay.
And after, let's say it's mortgage free.
Okay. So they own nothing on the home. It's $400,000 home. I owe nothing on my home.
Right.
Okay.
So they sell it. And after fees or whatever, let's say they have $370 that they walk away with. And that's what they're going to shop with, right? They haven't had a mortgage payment. They don't want one. So with the reverse for purchase loan, they can use that $370 as their down payment. And they would qualify based, like the same factors with the typical reverse, based on their age, interest rates, and the value of the home they're looking at. They would qualify for a certain percentage that they can carry in a reverse mortgage loan balance.
Okay. So they're using their money as a down payment. Mm-hmm. They're buying a home that's obviously more than the $370,000. Right. But instead of taking on a traditional mortgage for the remainder of that, which would have a payment, they can actually use a reverse mortgage for the kind of the balance of the difference?
Yes.
Really?
So whether that means they want to get more home for their money or, buy in a market that's more expensive,
for sure,
or whether that means they want to keep more of that $370 in their pocket, right? So they only want to put $250 down,
right? But
they can position themselves where they're just more liquid in the end and they don't have a required payment.
I think that's great. I love the fact. I mean, the reality is that, yes, equity is growing in our homes, but so is the cost of living. It's expensive and it's not getting any better. So I think the fact that you could actually use this to buy a home, get the home you need. Like you said, maybe they need more home or a more expensive area. And now they're able to still avoid that increased cost of living.
Yes.
Wow, that's great. That's probably, I think, an aspect when it comes to reverse mortgages that most people don't know about. I didn't know about it. So
right, and when you're having that conversation, you're looking at it's about options, right? Like we talked about, and if they're looking at, okay, if I want to do a cash purchase, I've tied up all my money, but I don't have a payment.
Right.
Do I want to do a small balance on a traditional mortgage? Maybe I do want to buy more home, but I'm going to carry a traditional mortgage, but it is going to come with a principal and interest payment. Or do I want to do the reverse mortgage loan option where I am going to not have a required principal and interest payment and keep a little more
Or
money in
maybe,
my pocket.
maybe I'm going to invest my money. Maybe I have $370,000 and I want to put a certain amount down and take the other money and I'm going to invest that.
Right.
And I have other business ventures.
Exactly. Hey, I did that on my own home with a HELOC,
Okay.
where I used the money that I accessed through a HELOC to purchase and rehab an investment property
boy.
combined with my own cash. I know. Risky, but I did it. So if I didn't have the option for a reverse mortgage,
Okay.
but if I could have done it with the security of not having to, know that I have to make a payment, I would have taken that option all day long.
No, I think that's great. Yeah. It allows options.
You can make the money work for you,
So I have a lot of clients who will look naturally to take out a line of credit, right? Home equity line of credit, so they can access the money that they want for taking trips or just the cost of living, things that they're looking for. But unfortunately, they don't qualify. Lines of credit are very strict when it comes to your credit score, the amount of equity you do have in your home, as well as your income. So I find that with my clients who are looking to retire, that's not really a good fit. A reverse mortgage really does seem to cover the bases on this and allows them a much better option.
Yeah, that's true, because that's a problem they face. They have to be able to take on what that payment could potentially be. And because a reverse mortgage doesn't take the debt to income into consideration or the credit score in the same ways that a traditional loan does, it's much easier to qualify for the reverse mortgage.
So that's a lot, right? We've talked a lot about the benefits, maybe when you could or couldn't qualify, and overall just basic information about the reverse mortgage. I learned about the buying a home and why that would be a good idea. Is there any parting thoughts? Anything you want someone to walk away from this video? They have to know this. Something you're thinking like, look, if you're thinking about reverse mortgage, make sure you don't forget or not know this.
Yeah. I would say that at the end of the day, you're not going to be able to put gas in the car, pay your bills, take the trip you want to take with the equity in your home without creating a payment, right? But the reverse mortgage gives you an opportunity to access that equity and use those funds for whatever you desire. So I would say it's worth a conversation and to just explore it and put it as another option on the table when considering whatever financial tool would be the best fit for you.
All right, that's a lot of information. Hopefully you found this useful. If you'd like to learn more about reverse mortgages or have any other questions, we'd be happy to talk through this. I always recommend in any situation when you're considering making a move with your finances, when it comes to buying, selling, refinancing a home, or maybe taking out a reverse mortgage, you want to talk to a qualified mortgage professional. We'd be happy to talk through that. It's free of charge, and we can let you know if this is a good fit for you or for your clients.